Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you joining me here on the East Coast. It's just past 12 noon Eastern Time. I want to say good morning to those of you in the Central Time Zones, the Mountain Time Zones, and the Pacific Time Zones. And of course, good evening, early evening, if any of you are joining us from across the pond in parts of UK, parts of Europe. Well, welcome to today's presentation. We're going to talk about using the PowerOptions tools to search for covered call positions. We're going to walk through some of the criteria, of course most of the criteria that investors can use on the PowerOptions tools to identify covered call positions. We're going to also show you various tools as well. Joe says good morning. Joe C says good morning. He's ready to sell covered calls. All right, Joe, well, we're going to show you how we use the tools to find new covered call trades and of course other tools to help you streamline that as well. Now, for those of you that don't know me, my name is Mike Chupka. I'm the Director of Education here at PowerOptions. PowerOptions, of course, is a patented suite of search and analysis tools designed for self-directed options investors. Ernie Zeriner created the PowerOptions tools back in 1997. Now, I've had the great pleasure of working with Ernie Zeriner and the PowerOptions staff for about the past 15 years. I do handle many of the coaching sessions and the online education for PowerOptions and radioactive trading as well. For those of you that are currently on a trial or are subscribers to PowerOptions, you know that you can schedule one of those coaching sessions at any time. It's essentially just a 40 to 50-minute phone conversation. Well, Ernie and I will walk you through the tools on the site and answer any questions that you have. I've also co-authored 2 books with Ernie on options investing and of course have done various seminars across the country, Chicago for example, North Carolina, Texas of course, other places, New York for example as well. Now I mentioned we support over 23 of the most commonly used option strategies. I am versed in all strategies on the site, but today we're just focusing on covered calls, probably the most popular options strategy. And many of you who might be doing other strategies as well, we realize that the reason why covered calls, is one of the most popular option strategies is that most investors own stock. So even if you are doing spread trades or buying some long calls here and there, you probably have some core holdings in your stock that you're occasionally selling a call against to maybe generate a dividend-like income. So you're still doing covered calls. And of course, as we know, for those who first get into options investing, when you apply with your broker to trade options, they'll probably start you off with level 1 trading, which might just give you access to being able to do covered calls, or maybe up to level 2 trading where you can do covered call positions and maybe buy calls and buy puts as well. So what we're going to cover today is the various criteria that investors can use on PowerOptions for both the stock and the option to find only those positions that best match their personal risk-reward tolerance. We're going to talk about tips on narrowing down the search criteria so you just have a limited view of results to help you save time. It's really the whole goal of the search tools on PowerOptions. We're going to talk about searching for specific types of covered calls based on your responses to a few quick questions we're going to ask you in a moment. And I'm also going to show you some tools to help you streamline the process, meaning tools where you can use sort of our tested historical results and our tested criteria to maybe help you identify covered calls more quickly that have a proven track record. Now, before we go any further, I just want to know a few quick things here. And the first one, of course, is those of you that are online today are interested in covered calls. You're probably already trading covered calls. And what I'd like to know is about how many covered calls do you trade per month? And this includes maybe adjusting or rolling positions. Maybe looking at about between 0 to 5 covered call trades per month or adjustments per month, maybe 5 to 10 covered call positions. I trade a little bit more, maybe 10 to 20, 12, 13, or 14 covered call positions. Are you looking at maybe 20 to 30 covered calls in a given month or a given time frame, of course? Or are you a large trader or large investor, or you trade multiple positions, maybe a smaller stocks, and you find yourself making more than 30 trades as well. Okay. This is a quick poll. Leave it open for about a minute, so we'll leave it open for another 15 to 20 seconds or so. All right, let me go ahead, and we've got most of our votes in, but let me go ahead and close that poll, and we'll share the results with everyone. It's pretty interesting here, so it's about in line with what I would do. what I have in my account. So about 46% of you are trading between 0 to 5 covered calls per month, and then we've got about 54% of you trading 5 to 10 covered call positions. Fantastic. Now let's take another quick question. What describes your main covered call approach? Do you like to sell in-the-money covered calls looking to be assigned, which have a higher probability of assignment? Take that assignment and look to open new trades with your return. Do you typically sell out-of-the-money calls on core stocks, kind of generate a dividend-like income, stumbling over that word today, dividend-like income on your core holdings or on your stock positions, hoping that they expire worthless? Are you looking at selling at-the-money covered calls for the time value, and maybe you take assignment if it goes up, or you adjust the position? Or are you constantly rolling and adjusting, having calls expire, maybe rolling calls if they're in the money, on a basket of stocks? Or do you currently not have an approach for your position? These results are very, very interesting. Okay, now they're changing a little bit, but I was surprised there for a moment. There was one answer here that did not have any votes in it, and I was kind of surprised by that. But it's picking up now. We've had the poll open for almost a minute, and I'll leave it open for another 10 or 15 seconds. All right. Okay, let me go ahead and close the results here. We got a three-way tie, which is what I kind of expected, but I was surprised there at the beginning. A lot of surprises the past 24 hours, I guess we should say. All right. 38% of you are selling in-the-money covered calls looking for assignment, maybe taking that return and moving on to a new position. That's great. What I was surprised at is in the first 30 to 40 seconds of the poll, when we had about 60% of our votes in, no one had answered that yet. It was kind of surprising. But 38% of you are doing out-of-the-money covered calls on core stocks. It's fantastic. And 38% of you are kind of selling at the money. 15% of you constantly rolling and adjusting your basket of stocks, and 8% of you don't have an approach. Now you're going to get some information for that 8% of you that don't currently have an approach related to in the money, out of the money, or at the money. But I'm going to encourage those 8% of you that say you don't have an approach. I would encourage you to schedule a coaching session. You'll learn some useful information today, of course, don't get me wrong, but I encourage you to schedule a coaching session. We can sort of review your needs and your trading goals and help you set up a trading plan or a trading approach for your covered calls. Last poll of the day, I promise, and we're going to jump right into the tools just to help us guide the rest of the presentation. What is your preferred time frame for covered call selling? Are you looking at weeklies, typically under 7 days, looking for that quick 3-day or 5-day trade? Are you using weeklies, but you find yourself between the 2-week out, maybe 10-day or 14-day out trading time? Are you looking at the standard expiration? You typically just open the next available trading month, December, maybe January. Do you typically go 45 days or more out in time to look for a higher premium, higher downside protection, but sit on the position for a little bit longer? Or are you in that field where you have no real preference, it simply depends on the premium available? This is great. This is exactly kind of what I expected to see based on other polls and things that we've run on PowerOptions. All right, so I'm going to leave the poll open for another 10 seconds. If you haven't voted, I encourage you to do so. And it looks like it's kind of staying. The results are kind of staying with the same number. So I'm going to go ahead and close this so we can move on. And we're going to address all of these issues, don't worry. All right, so 13% of you are looking for that quick trade, that low trade under 5 days, under 7 days. 40% of you are doing weeklies, but you're looking at more of that 10 to 20-day period, 10 to 14-day period to get a little bit better premium using weeklies, maybe going 2 weeks out, maybe as much as 3 weeks out. 13% of you just stick with the standard expiration, the next available month. 7% of you are doing 45 days or more out in time. 27% have no real preference, depends on the premium available. Fantastic. I want to thank you all for answering those polls here, so that's going to help me gear what we need to see for the rest of the presentation. Of course, as I mentioned, we're going to try to cover all of those aspects. Now, to get started, when we log on to PowerOptions, we of course need to go to the Covered Call tab, where we can select the various tools. The Quick Find tool and the option chain, very useful if you're looking for covered calls one stock at a time. We might review that later. What we're going to focus on today is the search. So we go into the covered call. We can click on search in the submenu or in the available tools section. Now, when you first click on the covered call search, you're going to see a listing of potential trades that appear. Now, it's important for me to comment that these are not recommendations or suggestions. The results that you see are based on Ernie and Mai's trading experience, and we've put together some default searches for you to use as a stepping stone to create your own personal search. So my advice is that when you open the search, if you haven't already created your own search, what you want to do is scroll down below the listed trades, and here we'll be able to see the parameter field. Now, the parameter field is separated into 4 categories. We can set in criteria for the options, okay, everything from the time frame, implied volatility ranges, return values, we'll review all of that, in the money, out of the money, price and strike price, and further down we'll also see liquidity, where you can set your option volume requirements and open interest. The technicals, we'll be able to enter in our stock technicals for our screen, whether we want to focus on average stock volume. You see here we have a default setting for this particular search of average broker recommendation, a simple moving average, Bollinger Band ranges, historical trends, and of course MACD as well. And the fundamentals, we'll be able to put in stock price ranges, ranges for earnings per share growth, or PE, price to sales. We can also avoid stocks that have an earnings date between now and expiration, or between now and a few weeks from now, and we can screen specifically for stocks that do or do not have an ex-dividend date coming up between now and our expiration date as well. And lastly, the lists field. This just allows you to choose if you want to screen against a certain stock list, things such as the Investors Business Daily lists, NASDAQ 100, Standard & Poor's lists, including the 5-star list, or you can exclude various lists as well. Now, for all of you who answered that one poll where we talked about, do you sell in the money, do you sell out of the money, or do you sell at the money positions, in the default view, you can start off with any of these default searches as a stepping stone to create your own personal search. There's also a screen here for weekly covered calls as well. So whether you want to be at the money, in the money, or out of the money, you can use this as your starting point and adjust a few basic criteria. Let's take an example. I'm going to look at the out of the money screen for the time being. We're at the money, so I'm going to change it to the out of the money covered call screen. But again, before I start going through the different results, let's scroll down to the bottom and take a look at what we have for this particular search. Anytime you open a search, on the right-hand side, you're going to see the active filters that are used. And we're not listing every filter, of course, for the options section, the technicals, or the fundamentals, but just what's currently being used. And for this out-of-the-money search, we're looking at the next standard expiration of December. We'll pull up an arrow here, it might be easier for everyone here. So we've set that to December. We're looking for a minimum downside protection of 2% or more, and a minimum percent if assigned of 2%. We're forcing it to be at least one strike out of the money, and a minimum option bid price of at least 40 cents. We've put in some other basic criteria. We want a broker recommendation of less than 2.6. This is based on the ZAC scale, where 1 is a strong buy, 2 is a buy, 3 is a hold, for example. So we're looking for anything that's between a buy and a hold to a strong buy recommendation. We want to follow the trend. We're looking for stocks that are currently trading above their 50-day moving average. And everyone has a different account. Okay, all of you have a different account size, and most of you have a different trading plan. The default here is we're just looking for stocks between $9 and $100. I'm going to review for you a search that I put together with a customer who had a coaching session earlier this week related to what his specific requirements were. Okay. Now, the earnings per share growth, Ernie and I typically use this for our bullish criteria, bullish strategies. The default search is for naked puts, pull put credit spreads, maybe standard collars. You'll see that we're kind of looking for an earnings per share growth. Our feeling is that a stock that is showing a growth in earnings will probably show a grow in stock price. It's a reflection of good management and good policies for the company as well. And in this particular search, we kept the PE related, reasonable range 0 to 70. I might even change this to go to 0 to 50. And because we don't really want any unexpected surprises with our covered call trade, we do want stocks that are going up. If we get a good gap up from earnings, be a good position to be in. We're going to get our return, maybe get assigned. However, we don't want to risk that stock that just has a terrible earnings and drops 33%, because even if you're using a stop order, if the stock falls 15, 20, or 30% in the pre or after market hours, after the earnings are released, you're still going to be on the hook for that loss. You're not going to get filled at your 7 or 8% stop order. You're going to get filled at whatever the market offering, and that would take a 33% loss. Okay? Now, those of you that said you were trading out of the money covered calls, we did have a high population of 40% of you said that you're typically looking at covered call positions only 7 to 20 days out in time. So that's really simple. The default here, we started off with December. If I want to change the time frame, I can go to all weeklies, but my suggestion for changing for option expiration time frame, change this to all months. This really means all expirations, whether it's flagged as a weekly from the exchanges, whether it's flagged as a standard expiration from the exchanges as well. We're going to go to all months, and we're going to change this to exactly what you guys said. We're going to put in a time frame of 7 to 20. Okay, so let's go ahead and submit that search. Now, we've narrowed it down to only 6 covered call opportunities that are between 7 to 20 days out in time, still have a downside protection of 2%, a percent if assigned of 2%, and are slightly out of the money. Have our requirement for 40 cents of the bid price as well. Now let's just look at some of these. There's Western Digital in here, does pay a dividend. Tesoro Petroleum, those of you looking to do out of the money covered calls on dividend paying stocks, we've got a couple dividend yields there. And of course Las Vegas Sands, pretty volatile, has a decent premium. We're all looking at the same downside protection. Now, about 2 to 2.3%. What is downside protection? The downside protection is calculated simply taking the option premium divided by your underlying stock price. What this is really showing you is how far the stock can drop based on the premium you received before you start losing money on your position. So most of these, are in 2% range. If the stock fell 3%, we'd probably have a 0.8 or a 0.7% loss on the position based on the premium received. The percent if assigned, of course, this is the maximum return if the stock is trading at or above your strike price and you get assigned on the position. Anytime you have a question about one of the available filters in the search, simply hover over the link next to the filter. You'll get a pop-up window that gives you a definition of that particular screen. Now, this is a nice, manageable list. And, if I wanted to focus on dividend-paying stocks, we just look at the ones, Western Digital, Tesoro, for example, that pay a dividend. And I'd use the more information buttons here to do further research on the stock, on the option, check out the recent news, and so forth. That's a presentation that we have archived that you might want to check out later on researching and analyzing a position. But let's say you wanted to open this up a little bit more. Is there anything that's really restricting more results? No, we know there's roughly about 500 stocks, indexes, and ETFs that offer weekly options that would be within this time frame. We also know that some of the shorter term options, 16 days out in time, we have 6 that are giving us at least a 2% return and a 2% downside protection, but other positions may just have a lower percent return if assigned. So we could just tweak this a little bit. I'm going to lower the downside protection to be just greater than 1.5%, and the same with the percent if assigned as well. Okay, now I'm just going to make those 2 changes. When you're making adjustments to a default search or your own saved search perhaps, you only want to tweak 1 or 2 criteria at a time. If I went in right now and made 7 to 8 different changes, I might hit submit and see that there are no results that match my criteria. But I don't know which criteria it really was that filtered everything out or wasn't working in conjunction with the other trades. Let's go ahead and submit this search. We're just making those 2 tweaks. We're going to open up our results a little bit more. And now we have 19. We have T-Mobile US is in there, Citigroup, Skyworks, for example, a little bit more volatile position, CBS Corp, and so forth. Even Tiffany is in there as well. Okay, so we've opened it up by doing a few simple changes to the criteria. Now, let's talk about potentially your needs and setting up a search from scratch. The default criteria, a great place to use as a stepping stone to help you save time. Start off with those default searches, analyze what Ernie and I put together in the default criteria in the active filters section when you pull up a default criteria, and then make your changes as necessary. But how would we originally think to look for a covered call position? Well, we don't have to talk about it. You're all covered call traders. You know what we're looking for in the basics. What are the basics? Well, covered call is a neutral to bullish position. Now, yes, if I am just a covered call trader, that's the only strategy I'm approved to do, and I'm trading in a market that I feel is bearish or risky, I might change my covered call strategy and go deeper in the money with my covered calls for better protection, or I might just pull everything out, stay in some cash for a while, and then look to do that. But the basics are, when we're opening a covered call, we want to look for positions that match our basic criteria, okay? And what do I mean by our basic criteria? We want to look for stocks that show bullish criteria. We're buying a stock, so once I clear the filters and empty everything out, I'm going to start off with the basics and the stock fundamentals. Now, the gentleman that called me the other day, he had a specific requirement of what he wanted to do. And it was a very simple search to create. He wanted to be in that time frame that 40% of you said you wanted to be in as well. I want to be in the 7 to 20% range. But he actually has a smaller account size. So his first criteria was he only wanted to look for stocks that were trading between $5 to $25 per share. He also had a requirement where he wanted his price to earnings ratio to be less than 40. Now, he did mention that he wanted to look for dividend-paying stocks, but he also wanted to look for non-dividend-paying stocks, okay? So first thing I'm going to do, I'm going to leave that blank. My suggestion was twofold. For this criteria alone, or this section, I told him that we want to look for growth stocks. So again, we're going to start off with that earnings per share growth of greater than 5, and don't want any sudden surprises. So let's check that box to avoid earnings date between now and expiration. You had one fundamental criteria. We suggested another that Ernie and I use for all of our neutral to bullish positions as well, and he had a limitation for his stock price range. Related to the technicals, you can put in a beta, of course, as a measurement of how the stocks move in relation to the S&P 500. If you wanted to look for stocks that were trading in the upper range of their 52-week high and low, well, I might just put in a percent of 52-week range of greater than 80. But if you also want to bottom feed a little bit, you want to look for stocks that are depressed. Well, I might look for stocks that are in the lower 30 percentile, less than 30% of their 52-week range. But another common criteria that I want to look for, potentially on my covered call positions, is I want to look for stocks that reflect a good liquidity, not just with the options, but also the underlying security. And this here, of course, this field is measured in thousands. We can hover over the average stock volume filter and see this measured in thousands. It's the average volume of the last 90 days. So I'm going to start off with a minimum average stock volume of 750,000 shares per day. In addition to that, let's again use our 50-day, our simple moving average. Now, many of you may have a different criteria you want to use. Some of you might want to look for stocks that are trading above their 50-day or their 20-day moving average. The range we're going to look for, that 7 to 20 days, I'm going to look for stocks trading above the SMA 20. But you could also look for stocks where the SMA 20, for example, is trading above the SMA 50, or the 100 is above the 200, or the 50 is above the 100 as well. Those of you that use MACD, I'm going to talk about that a little bit, and also Bollinger Bands later on in the presentation, a little bit more advanced discussion. But we can also specifically look for stocks where the MACD is crossed over the signal line. We've had a MACD crossover within the last 2 or within the last 3 days, for example, or where the MACD has shown more of a pronounced trend above the signal line. Maybe we only want to look for stocks with the MACD is above the signal line for the last 5 days or so. For now, I'm going to keep it simple, though. I'm going to leave that blank. So what have we done? We told the system that so far we have to keep our price range of $5 to $25. We had this PE requirement. We wanted to look for stocks that are growing in earnings and avoid earnings between now and expiration. Put in a basic filter for the average stock volume. We want to see some good liquidity, and we want to see a stock in an uptrend. Now, let's go to the options. And we're going to review this here. We already showed it. We want to go that 7 to 20 days again, right? So we're going to leave it at all months. I'm going to go 7 to 20 days. The time value. You know, if you're selling an out-of-the-money call, the whole premium is time value, and the percentage time value is based, of course, on the underlying stock price. When you're in the money, you know that your option premium is made up of two factors, your intrinsic value and the time premium. So if you have a requirement that you'd use for time value, you can put that in. But most covered call investors, I feel, will focus on the return ranges even more. And the returns that are mainly focused on, we already talked about one, the percent downside protection. When I enter a covered call, I want to make sure I'm getting a good enough premium to maybe where that downside protection is at least 2 or 3%. The percent if assigned. Well, this matches your trading plan, doesn't it? We know we're looking for relatively shorter term, 7 to 20 days out in time. But the percent if assigned is the max return on the position. Okay, and if you requirement, your trading plan written out shows you that you're looking to maximize your returns annually, meaning that you only want to enter a covered call that, let's say it has at least a 15% annualized return or annualized percent if unchanged, meaning if the stock doesn't move between now and expiration, you can put the annualized filters in as well. For right now, I'm going to put in the downside protection again of at least 2% and a percent if assigned of at least 2% as well. So starting point. Now, for those of you that mentioned we had a three-way tie, 38% of you wanted to sell in the money covered calls, 38% want to sell out of the money, and 30% generally sell at the money. Okay? Well, we have the fields here for in the money and out of the money. And you can do it by number of strikes for in or out of the money. What are number of strikes? This is sort of the ladder. Okay, so if you and I are looking at a $50 stock that offers 2.5-point strike differences, the 52.5 strike would be 1 strike out of the money. The 55 would be 2 strikes. What I find is most investors, though, want to use a percentage. Okay, so the percent out of the money based on the stock price. If I'm looking for an out of the money covered call, I may look for at least 2% or more. And I can restrict the upside. If I didn't want to go more than 5% out of the money or so, I'd put in a range of 2 to 5%. But in this particular case, looking for out of the money, you may not have to put an upper level on that field. As long as it matches your downside protection, your percent if assigned, of course, going 2% out of the money or more, as long as it's at least 2% out and it matches your criteria, will show up. We're going to see some different things here. I'm going to submit the search now, looking at the out of the money range, and we are going to have some few results because of our stock price selection. But here we have some good stocks. Names we know, Barrick Gold, Gold Corp, AK Steel, Tech Resources, Freeport McMoran, of course, that match the criteria for the call and for the underlying security. Okay, but let's change it. How would I set up a screen for in the money? We want a little bit more protection. Well, let's go ahead. I'm sorry, we had 14 results for out of the money screen, going at least 2% out of the money and still matching the return we wanted. But let's change it now. Let's force the system to go at least 2% in the money for all of our covered calls with the same criteria. We should see some of the same stocks, but we do have a few lower results. And the main reason why, of course, is when we go in the money, we're going to give up some of that percent if assigned. We're going to have much more in the percent downside protection, right? We get a higher downside protection by going in the money, and of course we see a lower percentage return if assigned as well. But of course, similar stocks in our very restricted price range and our criteria as well. And lastly, how would I set up an at-the-money search? We don't want to go more than 1 or 2 strikes, let's say, in or out of the money. Well, if you want to base it on number of strikes, it's really simple. In the number of strikes fields for in the money, we'll go blank to 1. Don't put 0 to 1. Okay, just leave it open. We'll go blank to 1. And for the strikes out of the money, we'll go blank to 1 as well. So the system knows to find only covered calls that are less than one strike in the money and less than one strike out of the money. Okay, so whoops, sorry folks, let's go ahead and submit that. And now it opens it up a little bit more because the at-the-money premium, remembers, where the highest time value is for our available options. And notice as well that we're seeing a mix, a really good mix of different time frames. We have those that are 9 days out in time and those that are 16 days out in time, but we still have a controlled universe of only 37 total results. Okay? So that's how you'd set up the fields for the in the money and out of the money depending on your requirement. What are some of the other filters we use? Well, you're also going to have inside your trading plan a minimum requirement for option bid. Maybe you do want to trade lower price stocks under $40 based on your account size, but you still have a requirement that you want to receive at least a 1% yield. So we'd probably, maybe look for a minimum of 30 cents. This is also going to depend on the average number of shares and contracts that you enter based on your account size and what your commissions are as well. For example, I had a call with a customer earlier today who was looking at doing covered call positions, just getting started, only wanted to do 100 shares in one call contract, and he knows that if he does a buy right at his broker, the commissions are about, I think he said $11.95. Okay, well, if he's only doing 100 shares in one contract, if he wants to stay shorter term, he should make sure that the option premium is probably at least 3 or 4 times that premium, in my opinion. So he's paying $12, let's call it, for commissions to open a covered call. To make it worthwhile for his return, he's probably going to want to be closer to maybe 45 cents minimum option bid price. He's going to give 12 of that back. So instead of getting $45 against the position, he's only going to get 33. But it still might be within the 2% yield that he's looking for as well. All right. For those of you that like to focus on less volatile positions, maybe that have a shorter bid-ask spread, you can limit the bid-ask spread field here for the call option you're looking to sell. So if you want to make sure the bid-ask spread was less than 20 cents or less than 15 cents, we'd enter that here. You can also do it by percent bid-ask spread. What that relates to is the amount of the bid-ask spread related to the option premium itself. Okay, the probability assigned. You can also use this to help you restrict if you want to be in the money, at the money, or out of the money. I just prefer to use the number of strikes. Those of you, I had it here, yeah, the 38% of you that are selling in the money covered call opportunities that are hoping to get assigned, take the return, and move on to the new positions, well, you're probably going to go ahead and look for maybe a higher probability, let's say greater than 70 or maybe greater than 75%. And of course, that's not going to work with the current screen we have up because we're currently looking at the money options here, so we'll have to change this as well or leave it blank because we know any call options that we're looking to sell that have a probability of greater than 70 or 75 are going to be probably at least 3 to 4% in the money depending on the time frame. And if you're looking for positions to sell out of the money covered calls, you're hoping to have those calls expire on a regular basis, keep the premium, and hold on to the stock without assignment, or worried about rolling the position, you're going to change it. You're going to reverse it just like we did with the in there out of money. You're probably going to look for a probability assigned of less than 40 or maybe less than 30. Not going to get as much premium as we'd want probably going that far out of the money, but again, you can use the probability to help you restrict that as well. But I find it easier just to be straightforward and use the range in or out of the money by percentage or number of strikes. Delta would also help you define in the money or out of the money, of course. And if your trading plan or the covered call technique that you're following implies that you're only going to sell covered calls that have a delta of greater than 0.6, well, we would just plug that in as well. Okay? Another thing we may always want to use is your liquidity for your option as well. There are various criteria that we can use. Open interest, of course, is the obvious one that I always use in all of my searches. But you can also screen by option volume today, the total previous option volume from yesterday's close, and you can look at percents. Now, what does this mean? The percent previous option volume is showing you the total call volume on the stock through all different strikes compared to your strike. And what that means is if you wanted to look for highly liquid options or options that maybe seem to be more trading actively, I could look for a percent current option volume of greater than 150. This would show me those positions that have a higher percentage option volume today compared to their average over the last 90 days as well. Okay, so we're just gonna, you can do that, of course, if you wanted to look for options that have that higher value, that have that higher volume. But we're just going to use open interest for an option volume today for some liquidity factors. And what I want to see as a general rule, if you don't have a rule for your liquidity, as a general rule, here's what we suggest. In addition to knowing your account size and what stock range you're able to trade or want to trade based on your account size, we also know that you're going to have an average of the number of shares and the number of contracts you're going to trade for the covered call position. So let's say your average position is 300 shares and 3 call contracts. If you don't have a feel for what you want to use for open interest or option volume, Ernie and my general rule is that you should look for an open interest that's at least 10 times the minimum number, at least 10 times the minimum number of contracts you're planning on trading. So I'll put in an open interest of 30, and I want an option volume today maybe at least 5 times the total number of contracts. So we'll put that at 15. I guess if you're doing 5, I might look at 25 and 50. And if you do 1,000 shares and 10 calls, well, I might look for an option volume today of 50, and of course an open interest of at least 100. Let's just go ahead and submit that and see where we stand. All right, so we've narrowed it down again to 19 results, but again, that's restricted based on our stock filters. Now, in addition to that, remember the customer said he wanted 2 things. He wanted to look for stocks that matched his criteria in the covered call screen for his time frame, some basic fundamentals, and we suggested some technicals to look for the stocks in an uptrend as well. But he also wanted to look for dividend-paying stocks, and that's not a problem. We'll just go ahead and put the percent dividend yield of at least 1%. Remember we had 19 results before with the base criteria. Oh no, so now we have no results that match this criteria with at least a 1% dividend yield. Well, let's go back to fundamentals and let's shrink this down. Let's look for, let's look for 0.5, see if any of those positions offer a 0.5% yield with our other criteria that we entered. Let's go ahead and submit that. All right, so there's our 3 that we saw, the Chemours Company, Gold Corp as well. And there are 2 calls for Chemours. The stock's currently at 20.50. So remember we took out, excuse me folks, we took out our range in or out of the money, but both the just out of the money 21 strike and the just in the money 20 strike both match our requirement for downside protection and percent if assigned. All right, let's open this up a little bit more. Okay, let's go ahead and change our stock price range to a little bit different. Let's go 20 to 100 or higher. Just put in the values that you want. Okay, so now CC is still there. It's at 20.50, but we've got Newmont Mining, Mosaic, Western Refining, and Holly Frontier Corp that are listed in our criteria. I just wanted to pause for a moment. Now think about this. There's 10 total results that match our criteria that pay at least a dividend. We didn't restrict out of the money, but we could easily do that. Just look for the out of the money or the in the money based on your requirements. Did we put in anything overly advanced? No. We put in this basic stock criteria of looking for some good average stock volume, stocks in an uptrend, what I'd expect to see for a covered call, even a cash secured naked put, for example. Price range based on our account size. I want to see stocks that are showing growth in earnings. I want positions that have a relative PE ratio. If you're price per sales, you can put that in as well. We wanted a slight dividend and avoid earnings between now and expiration as well. Okay, and then we've of course put in our criteria for our volume, open interest. I did limit the bid-ask spread. That might be having an effect on this on the higher price stocks as well. Minimum option bid price also. Okay, now one more thing I'm going to do here. If there's a sentiment, of course, across the market that, and you're taught this, and I was taught this as well, that when you're selling premium, You want to look for options that are considered overvalued, perhaps, where you're getting a better bang for your buck. Well, there's 3 criteria that you can use on PowerOptions, really 4, but there's basically 3 criteria that you can use to identify an overvalued option. The first is related to just the implied volatility. The IV over HV ratio is the implied volatility of your option divided by the volatility of the stock. What investors would look for to consider an overvalued option are those that have an IV-HV ratio of greater than 1, meaning the implied volatility is higher than the stock volatility. If I put in a range of IV over HV of at least 1.1, this would only show me the call options that are considered at least 10% overvalued compared to the stock's volatility. Okay, let's go ahead and submit that. Okay, so this narrowed it down to just CC. The other position we saw does not have an overvalued option. Another field you could use is the IV over SIV. Now, the SIV is very similar. What it is the stock's implied volatility index, and this is the average implied volatility of the near-term options on your stock. So what that means is it's looking at the in-the-money and out-of-the-money calls and puts for the next couple of months, taking the average implied volatility. So what we're asking is if I put it in a range of 1.10, it means the only options I want to see in my results are those that are considered 10% higher than the average implied volatility of the options surrounding it. Let's just see, are we going to get anything here? Oh, it's just the one. Okay, it's just the in-the-money call, the 20 strike call for CC, that's considered overvalued compared to its historical volatility and the implied or the average implied volatility as well. Okay, I'm going to take those out. Another filter that's simple to use is the Black-Scholes ratio. Very similar process. If you wanted to look for overvalued options, the Black-Scholes ratio is simply the actual trading price of your option divided by its theoretical worth using a Black-Scholes pricing model. So again, if I wanted to look for an option that's considered 10% overvalued compared to its theoretical price, we would just put in that range of 1.10. And then there's also a Black-Scholes, but it's using the implied volatility, the average implied volatility for the options as well. I am not necessarily, remember when we put in the overvalued options, we start that way, we just narrowed it down to CC, and only one, our 20 strike, would have considered overvalued, both compared to the options surrounding it and the volatility of the stock itself. I'm not necessarily a proponent of looking for options that are overvalued or undervalued. I have customers that have a very basic screening criteria. They don't use stock fundamentals or technicals. They look similar to what we're showing here, 7 to 20 days out in time. And all they want to see are options that are considered at least 30% or more overvalued with IV over HV and IV over SIV. Just looking for high implied volatility positions that are considered overvalued. My trading plan is a little bit different. Here we have 10 results in our stock price range that match our technicals, our fundamentals, and what we'd want for our trading plan. The minimum 2% downside protection. I'm not entering a trade unless it's a minimum 2% if assigned. It has the return and the protection I want, and these stocks match the criteria that I'd want to see. Now, I'm not saying all of these are going to be right 100% of the time, don't get me wrong. But if Newmont Mining, if I start doing my research, I like the stock, I like the out-of-the-money premium here, just out of the money, the 38 strike on a stock trading about $37.50, would just give me a 2.9, almost 3% downside protection and a potential 4.5% if assigned. If I like the stock and I think it's stable and I like this return and it matches my trading plan, am I overly concerned if the market thinks this is overvalued or undervalued? Not really, because it fits within my trading plan and then the stock has the criteria that I want to make me feel comfortable with a covered call position. So I'm not overly worried if it's the market considers it overvalued or undervalued because it fits into my trading plan. And that to me is more important than trying to find the hot option or the best premium. And as we all know, we've been in these situations before. I'm going to show a quick example of it in a moment, but we all know that sometimes there are covered calls that are out there and other positions that look too good to be true. I see a covered call on a stock trading, let's say, at $10 per share. where I can sell the out-of-the-money 11-strike call and generate $2 worth of premium. Well, geez, it's like a 22% downside protection with a potential for a 33% return if assigned. My probability is probably about 45%. I could go in the money on that same stock, sell the 9-strike call, perhaps, and maybe generate $4 worth of premium. So now I'm getting almost a 40% downside protection, and at the same time, I'm still making a little bit more than about a 40% yield if assigned. And I have a 70% probability. Now, if those positions are out there, which they are, this tool will find them. But if it looks too good to be true, it probably is. I forget the exact ticker. There was a stock a few weeks ago that was about that price. I think it was an $11 stock or a $12 stock. You could sell the at-the-money $12 call for $3. All right? You've got your almost 33% downside protection. You've got almost a 33% if assigned on the position. All right? And what's the worst thing that can happen? Well, naturally, there's a biotech. Phase 2, Phase 3 trial come up. What happened? The stock dropped to $2 per share. Your 30% downside protection helped, but you're still losing 80% on what you invested in that trade. And you lowered your cost basis down to $9, but now it's trading at $2. So you've got a $7 loss essentially on the position. You had a $9 cost basis. If it looks too good to be true, it probably is. Focus more on the stock criteria and look for quality stocks that match the strategy, not overly focusing on what is the best return. But again, let's just start that from scratch. Let's see if we can find some more positions like that. I'm going to clear the filters. And we're just going to look for standard November expiration 10 days away. Okay, and we can do that at any time. Select the month you want. Also earlier, remember, those of you that said you were looking further out in time, when you're creating your search, just go all months, and you can put minimum of, let's say, 40 days to maybe 95 days out in time. Use all months. That really describes all expirations, not just standard months expirations. Okay, but I'm just going to choose November. I've cleared all the stock criteria out. I'm only going to look for covered calls that offer, let's say, at least a 25% downside protection. With a percent if assigned, let's call it at least 20%. I'm going to restrict it to be in the at the money. So we're going to put in our range, number of strikes in less than 1, number of strikes out less than 1 as well. I'm not going to worry about option, bid price, or anything else. 10-day out trade. Let's see if we find anything with at least a 25% downside and a 20% if assigned. Okay, nothing there. I'm going to lower this down. Let's go 15 and 10. There we go. What did we expect? Corbus Pharmaceuticals. Stock's trading at 628. The 750 strike is trading at 508. I'm sorry, 120. My apologies. It's trading at 120. This gives you a 19% downside protection and a 47.7% return if assigned. What could go wrong? Well, if Corbus, highly inflated obviously, why don't all the other covered call opportunities out there have this premium? Well, it's highly inflated. There's a lot of risk. It may have a phase 2 or a phase 3 drug trial coming up in the next week or the next 2 weeks. Maybe we go through November 18th and the announcement for the trial hasn't come out yet, and we get lucky. And either the 7.5 call expires worthless and we've got a 23.6% return, or if we sell the 5 strike with a 33, almost 33% downside protection and an 18.3% return if assigned, okay, maybe we get lucky. Maybe the announcement comes out on Friday and the stock drops to $2 per share. Well, you're still at a 50% loss. You had 32% downside protection, but if the stock falls to $2 or lower, you had a net debit of $4.23. You've got a $2 value for your position now, so you've lost over 50% on your investment. If it looks too good to be true, it probably is. If this is your mode of trading, the PowerOptions tools, look at it. We narrowed down the entire universe of options. All close to 4,000 stocks, indexes, and ETFs have options that are expiring in 10 days on standard expiration. We've narrowed that down to 2 results that match this very high return. But now I've got to do a lot of due diligence. I've got to look at a lot of the company news, and I've got to figure out from the headlines, when is this report that's causing this inflation likely to come out? Okay. Now, we are at 1250. And what I wanted to do is just show you 2 quick things, how to create a search. Some of you might be doing specific stocks for ETFs or higher dividend paying stocks, and that's fine. we're going to walk through simply how to create those searches using different fields. If you have questions about a certain search criteria or anything along those lines, or about using the search tool or covered calls, use the question pod in the GoToWebinar platform. Go ahead and send that to us now, and we'll address all of the questions as we go through. All right, let's clear the settings once more. I'm going to empty everything out of this field, okay? And we're going to start from scratch. We're going to look at standard December expiration. We all know now how to set the time frame that we want. I'm just going to use standard expiration. Let's say that you wanted to trade ETF positions for a little bit more stability, a little less volatility, okay? But you're still probably going to want to be, whether in or out of the money, or at the money, for example, you're still going to want to have some decent criteria. So we're going to start off again with our downside protection of at least 2% and percent of a sign of at least 2%. Normally, okay, what you're looking at on this position, going 37 days out, I might look for higher. I might go for a 3 or 4% return if assigned. I'm sorry, yeah, 3% return if assigned, and maybe a 5% downside protection. But knowing that we're looking at an ETF, okay, what we're going to do here, we're going to put in an option volume today of at least 10, okay, and we'll keep this at 25, for example. But what's really easy to do is I can just go to the lists field, and I'm going to select to just look at indexes and ETFs. Okay, let's go ahead and submit that. I'm doing this on purpose. We're going to see a lot of results, okay. A lot of results I personally wouldn't trade. You have a lot of premium here and a lot of good returns for these things such as the ultra short, ultra long, 2 times, 3 times bull, 3 times bear ETFs. These are more volatile positions. They can swing against you just to swing with you. I mean, look at JNUG today. It jumped up $1.19. Its opposite, the junior gold miners 3 times bear, would have dropped in a similar percentage. So if I did a covered call yesterday on a 3 times bear gold ETF, I'd be looking at probably a 4 or 5% loss today, even with my covered call premium. So I want more standard securities. And by the way, you see here we have 204 total results. The whole point of this tool is to help you save time. So we want to narrow that down. That's too much. I want a nice basket of trades that are only within, maybe under 30, okay, for any strategy. But what do I know here? What I want to do, there's probably 2 things I want to avoid. And in the list, I can choose to exclude that as well. So I can choose to avoid the inverse ETFs. Hey, because I'm in a neutral to bull. If I feel I'm in a neutral to bullish market and I want to open those positions, bullish strategy, then I want to avoid the inverse. I don't want to look at bearish strategies or bear ETFs. I'm looking for a neutral to bullish position. I'm neutral to bullish on the market. But I also might want to lose the leveraged, which is more important to remove here. Well, anytime, in addition to being able to select lists that you want to view, you can also create your own personal list. If you have a basket of 20 or 30 stocks that you specifically want to screen against for a strategy, or we can combine lists. So let me click on that Create Modify Lists field. Okay, and what I can do now is I can create my own personal list, or I can click Combine Lists. What this will allow me to do is create a list name. So we can just call it ETFs to remove. I'm actually not going to create this. I'm going to show you the process. And now I can choose different lists that have already been created, that I created, or they're in the default list. So what I want to remove is both the inverse ETFs and the leveraged ETFs at the same time. And I'll go ahead and click Create, and now I'll be able to select to remove that created list. I've already done this in a previous webinar, so let me cancel that. And you see I have ETFs and ETNs to remove, and it's roughly 958 securities. It's a combination of the leveraged ETFs and, of course, the inverse ETFs as well. All right, so let's go back to list, indexes, and ETFs. Now I want to go ahead and remove my created list as well. Okay, so let's go ahead and run that again one more time. No stock options match my criteria. Now that's interesting, because I didn't put a lot in, did I? I looked standard December expiration. I did remove the leveraged ETFs and the inverse. I don't have any other stock criteria. So where is IWM, for example? Where is SPY? Where's QQQ? Because of lower volatility, I may have to reduce my restrictions here for this list. Let's take it down to 1 and 1%. All right. So it's the volume now. Let's just go greater than 0 with an open interest of 25, see what we get. You know what? Let's do it a better way. Let's include all weeklies in there as well. You know, I think I broke this list. Let's go back there and check it out here. Let's go back to create modify list. It might be too high. What do I do there? Let's edit this. My apologies on that. Okay, so I just want to remove. Oh, that's why. I'm sorry, that's what I was afraid of. Let's go back one more time. I was removing the actual list. That's if you wanted to remove everything, indexes and ETFs. All right, so now they're back. But let's go back to our December range. Okay, so that's just a recommendation here. I'm not going to play around this too much more. We do have a couple questions I want to get to and show one more thing. Two more things, actually. Okay, so here's some of the standard ETFs. PXX is dominated by that, by the higher results. GDX. Okay, so let's go back to our 2 and 2, now that we have the proper list structure. And we may still want to follow that same pattern, where I do want to look for a stock in an uptrend, okay, above the SMA 20 or above the SMA 50, filter this down a little bit more. 55 total results, and we see some things in here, GDX, of course, XBI, the biotech, JO. And you say, okay, well, you have 55 results, I see that. I see some popular ETFs in here. Where's SPY? Is it in my list of matching this downside protection and percent if assigned? Well, rather than go through all 3 pages, you can just go to the fundamentals. I want to look for one position at a time. Let's see, are there any SPY opportunities within our time frame that match our criteria? No. So SPY probably has lower volatility. We'll have to narrow this down just to see. So that search by symbol tool is very useful. There they are. There's no position on SPY right now going out to the December series or the weeklies that offers at least a 2% downside protection and a 2% of assigned. Those that are in the higher range percent if assigned don't have as much downside protection based on the price, okay? So that's what you want to do. If you run a search based on your criteria, and I get this a lot. Customers call up and they say, hey, I just ran a search, but I'll use Joe's example he wants me to go over, but Facebook isn't in there. Why isn't Facebook there? It matches the stock criteria I want. Well, there is a filter there. The system's not broken. The tool is not broken. I can break it by accidentally selecting too many lists to remove for an ETF and ETN, as we just saw. But the system's working perfectly fine. If it's not there, it's because one of your other criteria might be something as simple as the volume or the open interest for the option, or it might have a 0.9% if assigned and a 1.5% downside protection, but it's just being filtered out. Doesn't mean it's a bad trade, but if you don't see a result you're looking for and you've got 40 or 50 results, go to fundamentals, plug in SPY. For the dividend, those of you who want to look for stocks that pay a dividend, whether it's a high dividend or medium dividend, I'm going to suggest the same thing. Keep it simple. Clear the filters. Select the expiration month that you want or your time frame. Put in a minimum requirement for downside protection and percent if assigned. Maybe put in looking for stocks above the 50-day moving average, but just put in your required dividend. Start off with the basics. 3 criteria right now. Let's submit that. All right. 400 results. Way, way too many. All right, that match our criteria, and the dividends coming up. So of course we want to see something that's a little bit liquid. Let's put in our 10 and our open interest of 25. Oops, sorry. And then back away on stocks that are in an uptrend. And of course we know maybe our stock criteria is we only want to look at stocks for $15 to $150 per share. And if we wanted to, we could select to just look for positions that have the ex-dividend date between now and our expiration, or not between now and expiration, depending on your approach. So let me just change that real quick. Only change 2 or 3 filters. We've got it down to 30 total results. Popular names, Lilly, Mosaic, Macy's, Polaris, and so forth. Okay, let me get to the questions here. 2 from Scott, or I'm sorry, not Scott, I apologize, 2 from Joe. Joe says, I have 100 shares of GID. How do I select the best strike and expiration? You're going to hate me for this, Joe. I'm going to show you what I would look at, but there is no one answer to that question. There is no such thing really as the best strike for a covered call. There's ones that would make no sense. I'll show you those, okay, in general. I know what my theory is for the best strike, but remember, 38% of the audience today said that they look for in-the-money covered calls to get assigned, which matches their trading plan. 38% trade out of the money, looking for speculation of a stock growth, or to just have a dividend-like income and have the call expire on a regular basis and lower the premium. And 38% focus on the highest time value, not the highest return necessarily, but the highest time value return by going at the money. So why do I say that? If I had all of you in front of me and I split you up in the room here, and we had 38% of you with the in the money category to my left, 38% of you in front of me at the money to my right, or right in front of me, and the out of the money's over to my right, I say, what is the best strike price? Well, 38% would say in the money, 38% would say at, and 38% would say out. It's different ways to approach it. It's got to be based on your expectation of the stock, Joe, your risk tolerance, okay, for a trade, and the return you desire for your trading plan, okay? Now, I'm going to answer your question. I cannot give you direct trading advice on a position, but I'm going to answer your question using the tools. There's two tools to use to help you find positions one stock at a time. The quick find tool, which is very simple, very useful, and very basic, but it doesn't give you a lot of the information you might need. But let's take a look. If I go to quick find, and I'm just going to put in 100 shares of GLD, and I'm going to say I'm neutral. Okay, just relatively neutral. Could be slightly bullish, slightly bearish, but we're going to go neutral. And click the button here that says Get Money on the Table. What this tool shows you, of course, is the likely calls that you would sell in this position. GLD is at 121.82. Well, I could go out of the money slightly with the 123 call, which would generate $199 for me right now. I'd have a potential profit of 318 if the stock's trading above 123, and I have a 1.6 downside protection. The at the money, this is all this tool is showing you, is just the money on the table if you went out, at, or in. Okay, so going at the money at the 122, we get more money up front, lower return if assigned, but a better downside protection. And the in the money, higher money up front, but most of that is intrinsic, so we have the lowest percent if assigned, a better downside protection, and you have a higher percent if assigned, of course, higher probability the stock will stay above 121, and you'll make that return. And this is looking at standard December expiration. Okay, but what isn't this tool showing you? It's not showing you probability. It's showing you downside protection, but it's not showing you percent return if assigned. It's designed to be a really simple tool to use, sort of for new covered call traders. What I like to use is the option chain. So under the covered call tab, I'm going to click on option chain, and I'm going to put in GLD. Okay, now I'm going to get all of the expirations that are available. November 11th, all the single strikes. It can be overwhelming, I know. 7 days away. November, 9 days away. Okay, and then we can look further. I'm sorry, the 9-day out one, standard. November 25th would be 16 days out. Yeah, there's the 16-day out trade, of course. And then we could just go, hey, what about standard December expiration or the 9th? Which one's the best one? Well, what I'm looking at here is what matches your goals. Okay, what is your trading plan? Here on the cover, why I use the chain, I know this is a little bit hard on the eyes with a stock that's in the $100 range that offers 50-cent strike differences. I tell you, it's driving me nuts, guys, ladies and gentlemen. The new things that are coming out, 50-cent strike differences on $100 stocks and 7 different expirations. Which one's the right one to choose? I don't know. Honestly, I don't know. Is the 122 strike really that much better than the 121.50 or the 121? Well, they've got different numbers, so based on what happens, we could say yes, but we don't have that crystal ball. So it's got to match your trade plan, Joe. That's what it is. And many investors, rather than setting a static plan for, okay, excuse me, I'm going to open a covered call that's within the 20 to 40-day range and offers me at least a 1.2 or 1.5% downside protection, but still has to have a return of 0.5%. Which one's best for me? Okay, well, that's what the option chain shows you. But I want to show you something different, Joe. Okay, we talked about the option chain and the quick find tool. Usually, when I'm asked this question, I'd say the best one is got to be the one probably at or slightly in the money. Why? Out of the money is great. You get a lower premium up front, but we're still looking at some decent premiums here. We get a lower downside protection if we're wrong and the stock falls, but we get a higher percent if it's signed because it's taking in that intrinsic gain plus the other. So Joe, if you're really bullish on GLD and you think in the next 5, 10, 15 days, the stock's going to continue to move up here, we're going to see another 1, 2 to 3% movement, this range out here, slightly out of the money, might be a good trade to use, around $1 premium, around a 1% premium, 0.9% if unchanged, 1% if unchanged, with still the potential to make close to 2%. This might be where you'd want to focus. If you're concerned that the market might pull back, that we might see a little bit of downturn, or especially in gold, if you think it might pull back from where it is, we want to go slightly in the money to give ourselves some downside protection. Really, I think the best covered calls are within 2 to 3 strikes, really 2 strikes out of the money to 2 strikes in the money. So the at the money, 2 strikes in or 2 strike out, I feel are the best. If you have a core holding in your account and you're fearing something's coming up, you may want to go deeper in the money to give yourself a little bit more protection with the premium that you generate. But really, I'd prefer to see you maybe do an at the money covered call, even if you're bearish on your stock, and then add a cheap put to create a collar. That's the best insurance you can get on the position. All right, so Joe, for your case, let's do what we just did with the ETFs, but do it a different way. And I think it's easier with these higher price stocks. You also mentioned Facebook, which is the best one. Let's just use the search tool, okay? Now, I'm not saying this is the best time frame to select, Joe, but your fellow covered call traders, 40% of them feel that the best is within that 7 to 20 day range, okay? Maybe 2 weeks out or so in that time frame. Let me go to our weekly covered call screen that Ernie back tested, did some testing on to see which was the best ones. The reason why I want to pull up this default search for a moment, here we go, is that this one here is less than 8. But a lot of the times, so it'll show us the 2-day out, but in general, when we look at the weekly screen, we do feel, Ernie and I feel, for naked puts, bull puts, credit spreads, and covered calls, that second week out is usually the best time frame. It does give you the best doesn't give you the best annualized return compared to the 2-day out or 5-day out trade, but you get more premium. See, some of these positions only have 37 cents or 42 cents a premium for the 2-day out trade. That sounds fantastic. But you're not hedging it by that much. If you go out further, 70 cents at the same strike for only 6, 7 more days of trading appears much more attractive. Okay, so with that in mind, Joe, I'm not going to tell you what the best one to do. Let's talk about what our fellow covered call traders are looking at today. Now, across the board, we have an even split of in and out of the money. But 40%, the winner, we had 40% saying that they're trading within a 7 to 20 day time frame. 13% were less than 7, and 13% were looking at standard. Okay, so I'm going to say not every security, though, offers a weekly option, which is why I'm selecting all months. Why? Because this is even going to show me standard November expiration, and in addition to that, anything that's in any of the weeklies that'll match my other criteria. Okay, so 7 to 20 days out in time. You can go to December if you want for more premium. That's perfectly fine. We're just starting off with this. I'm not going to concern myself with implied volatility or overvalued or undervalued because you already selected the stock. You already own the stock. Okay, so we know that going out in time, we're going to want a decent downside protection, and we're going to want a reasonable percent if assigned. I'm going to keep it at 1.5%. We don't have to worry about any stock filters. What I'm doing here is, what is your trading plan, Joe? What is your requirement for annualized return if assigned, percent if unchanged, okay, and downside protection? Why are you trading covered calls? For the premium and the return. What are your goals long-term for an annual track record? You're not going to get it every year. I understand that. I can set my annualized percent if assigned to 15%. That doesn't mean I'm going to make 15% over the next year. I'm going to have to factor in winners and losers and apply my management techniques. But if that's my trading goal, that's where I'm going to start. Okay? Now, so we did with the SPY a moment ago. Let's just go into fundamentals. And we'll do one at a time. I'll do GLD. Okay? This is your stock. I don't need any of those criteria. Oh, no. Let me take this out. Okay. Oh, well, I know that this 7 to 10 frame, why am I not seeing what's there? because we got to do this a little bit better, don't we? And we already saw that from the option chain. So I got to restrict this lower. Let's look for the one that's at 1-to-1. There you go. Here are your two strikes, as close to the stock price as could be at the money. Does this mean these are the best covered calls in this time frame? Not necessarily, but they're the ones that match your trading plan. You see, it's a swap. If you go slightly out of the money, you still generate a good premium of $1.39. This gives you a 1.1% downside protection and a 1.3% if assigned. You go slightly in the money, you get a higher premium, but you're giving 31 cents back to intrinsic value, so you flip-flop. Now you get a 1.3 downside and a 1.1% of return. This is really the main focus of a covered call trader. I want to get the return that matches my needs, but I also want to have a reasonable downside protection. And for GLD, lower volatility, keeping it in the shorter time frame, we don't get that. Okay, now Joe, let's go back just a bit, and let's say your requirement is you want a minimum 2% return if assigned for a covered call, and you want at least a 2% downside protection. Nothing in this time frame matched your results. What does that tell you? You got to go further out to get the better premium that gives you that. Let's go to December. And I'm pretty sure we're going to be focused right at the money again. There we are, slightly out of the money. Still giving you a 2% downside protection and a 2.3% if assigned. You say, okay, well, this is the December 30th, by the way. This is the actually not the standard expiration. It's sort of the quarterly there. But you might be saying, well, maybe I want to be in the money. Where's the 121 strike? Well, it's not here because it probably is not giving you a 2% if assigned. It's probably at 1.7, 1.8. How would I check that? Very easily. Just click the More Information button, go to the option chain. And I'm sorry, we'll go to that December. It was the 30 that was 51 days out to do a fair comparison. Here's our 122. So it's right at the cusp, isn't it? Probably a decent trade. The 121 strike, 2.5% yield for 51 days. I'm sorry, 1.9% max return, almost 2%, and a 2.5% downside protection. But we're in the position for a longer time frame, aren't we? Okay, we're going to be holding that position 51 days and have to do management during that time frame, perhaps. Okay, but this is how you can easily use the search tool. Just put in the time frame you want, whether it's a series of days. You know, we looked at 7 to 20. Maybe we want to increase it. Let's go back to all months here, and let's plug in that we want to go 14 to 40. Right? So include standard December expiration, anything that's 2 weeks out. Keep my 2 and 2 returns. And here's your Facebook trade, okay? Okay, now is this the best one? I'm not going to say it's the best one. Okay, I don't know what Facebook's going to do for the next 30 days, the 9th of December expiration, but it's giving you the downside protection you want of at least 2% and the percent if assigned. I'm not saying these are your goals, Joe, but this is how you can use that tool to easily identify what is the best expiration strike price to use. I like this range. I might even go 10 to 40 days, perhaps, okay, depending on what your trading plan is. But put in what you want to see for downside protection and the percent if assigned or the annual, and then just go into fundamentals and put in your stock symbol, and you'll be able to see it. Am I saying this is the best strike? No. But if this is your trading plan, this would be the best strike for you on Facebook right now with the premium that it's offering and the percent if assigned. We're not talking about stock chart reading and should I be bearish on Facebook or bullish on Facebook. Create a trading plan. You got to stick to your trading plan, and this tool will allow you to find it one stock at a time. And of course, if you have 10 stocks that you're tracking and you want to see what is the best one based on your trading plan, that's when you'd create your own personal stock list. Create a list of your 10 stocks, save it, screen against it, just looking for your criteria of time frame, minimum return, minimum protection, and maybe minimum option bid price as well. All right, now I promised earlier that I'd help with streamlining. In addition to the search tool and creating your own search, and we also talked about how to adjust the default criteria, use the defaults as a stepping stone. But we've gone one step further. In the past months or a couple months, Ernie released 2 new tools for covered calls, the Pics of the Day and the Weekly Pics of the Day. Now what this are is a back-tested set of criteria that Ernie used. You can see here the exact filters he's using. Next monthly expiration, this is the standard expiration pick of the day for covered calls. No earnings. Stock must be trading above the 50-day moving average. Looking for some liquidity and open interest. There's that positive MACD signal. yielding at least a minimum 0.8% if assigned and a downside protection of at least 10% and a high broker recommendation. Well, what do these criteria mean? Well, you click here on this link to see how we develop these results, and what this walks through is Ernie did many iterations of various criteria using implied volatility. Did that help looking for higher implied volatility? Did that help or hurt his covered call results over a 12 to 15 month period? Did higher volume help or hurt it? Did higher option premium help or hurt it, for example? And he ran many iterations, and in this particular one, you see here the historical results, 30 positions that were found over a 12-month period. Okay, started off with a $100,000 base account. There's some management discussed in here as well, but over that 1-year test period, and you can see what the SPX did above during that time period, it was up 24%. Okay, there were 2 losses averaging 24% on each one, and 28 wins that had a gain of 4.3% over that time period. Okay, largest drawdown from previous month was about 21%, probably because one of those stocks fell. Okay, but this is to help you streamline. You can see the picks of the day, and you can also adjust the picks of the day to match more of your criteria. And there's also the weekly picks of the day as well. These are looking, for the shorter term trade, and you can click on that, see how we develop these results to see the track record of those as well. It's also available for naked puts. But back to the search very quickly. Both on the picks of the day and the weekly picks of the day, historically tested results, here you can see those results. They're also available here. All right, so if I go to picks of the day, here's that same criteria that we just saw, different one that came up there. And it's because I'm on 20-minute delayed here. But if you look at the listings, let's say that you wanted the picks of the day. This only gave us one result, but if you had a requirement that you only wanted to see stocks trading between $9 and $75 per share, or based on your criteria, you could change that and see if there are any positions there. Use it as a stepping stone, adjust the criteria based on your needs, and see what you come up with. If I only have one result, well, it's not going to help me too much to adjust the criteria. Okay, so in general, the best call to use, you can use these tools, Joe, to help you find them. Use that search by symbol tool in the fundamentals, which is basic option criteria, but I think you're going to find the ratio of downside protection to percent if assigned and what matches your goals. The at the money or slightly in the money covered call is probably going to be the most attractive. You don't want to go too deep in the money because then you don't get any positive yield. You're getting too high of a delta. You don't want to go too far out of the money because you have such a low option premium and you're speculating too much on a large stock movement to get that higher return if assigned, which is factoring in the intrinsic gain, not really the premium you're receiving. So keeping to at to slightly in the money, always where I look to focus. If you're in a raging bull market or you think that we're in a raging bull market and it looks like things are going to move up for the next 3 to 4 months or so, speculating out of the money might be very profitable. But remember, your downside protection is always going to be less, be lower for the positions that don't go in the direction that you wanted to see. All right, well, ladies and gentlemen, I think I got all of the questions that came in. If you have any last-minute questions, I want you to go ahead and send those in to me as well. We're just going to go ahead and wrap up here. Just remember the basic tips on using the search tool. Use the default criteria or your saved searches as a stepping stone. Once you go into the search, you pull up the default search, adjust the criteria to match your needs, but only change 1 or 2 at a time. After you make 1 or 2 adjustments, hit submit, see how you limited your list. You don't want to make 7 or 8 criteria changes at once. Okay? If you feel you want to change 7 or 8 criteria, you're going to be better off clearing the settings and starting from scratch. Right? We looked at a lot of criteria today. There's still a lot of criteria I know in the covered call search and in the PowerOptions searches, but don't feel overwhelmed. Start by using the criteria you use in your trades to identify neutral to bullish stocks that you're comfortable with in the covered call and entering in the return, the downside protection, and the range in or out of the money that matches your specific trading plan. Never feel pressured to put in criteria for every available filter. If I put in something to every available filter, even if it made sense logically for what I was looking for, I'm probably going to get no results. Okay, it's just going to be too much. So just put in the criteria that you want. You saw how we created that search from scratch. Now, true, we started off with a restricted stock price of $5 to $25. We had only 10 or 12 results. But even when we opened that back up to 25 to 100, we were still looking at only about 15 or 18 results, which is a nice manageable list across the entire universe of options. It's helping me save time, narrowing it down, and I'm sticking to the trading plan. So again, if you have a listing of, I'd say even 5 or 6 or more criteria that are important to you when entering a covered call, clear the settings first. Set your time frame. Put in your return and downside protection and maybe 2 or 3 of the stock filters that are most applied to your trading plan. All right, run that search after those basic criteria, and if you see again maybe 150 or 200 results, now you can start filtering further. Increase the return. Maybe look for positions that have better fundamentals or technicals and get that down to lower range. When screening for ETFs, remember you can remove the inverse or leverage ETFs, and when screening for dividend stocks, always start with no list. Don't put in the S&P 5-star list, but you can also use that. The bullish list, the Investors Business Daily 50, the IBD 50 and CanSlim, the S&P 5-stars list. If you don't know what to put in for what is a good earnings per share growth, price to sales, price to earnings, you can use those company lists as a stepping stone, as a starting point, because they're designed to look for bullish stocks, essentially, based on criteria as well. But when looking for dividends, I suggest starting with no lists. Put in your minimum requirement as well for the dividend, and then select your time frame as well. Okay? All right. Question came in from Miguel. Can you set up an alert for your criteria once the condition is met for a particular option? In the search, Miguel, no. But if you entered an option or a covered call, let's say, into the portfolio position, or if you entered a call and your requirement was that you wanted to see it at a certain, you want to be notified if it was at a certain option bid price, if it hit a certain percent time value, for example, you can set that, not delta of course, but you can set that in the portfolio, and as a subscriber you can have the portfolio alerts emailed to you. On the search, once I create my criteria and I save the search, I didn't walk over that, but you can click the save button, create a name for your search. Now every time you come back to PowerOptions, your criteria are saved for you. You can select to have your search results emailed to you at a given time during the day once you create a search. So you can have it sent to you at like 10 o'clock, 11 o'clock, 12 o'clock, so on and so forth as well. But it doesn't have an alert that, covered call on XYZ just matched your return of a 2% yield and a 2% FSI. The search tool doesn't do that, Miguel, but you might be able to set something up similar to that in the portfolio tool also. Okay? All right. So remember, those of you that haven't yet, you can just go to powerop.com at any time, put in your first name and email address, and you can start a free 14-day free trial. You'll have access to what we saw today with all the searches for all the strategies and 20-minute delayed quotes on the trial. After that, we do offer an end-of-day service. The data is only updated at the end of the day, and that's $40 per month. Most popular service is for the 20-minute delayed service, so it's $60 per month. We do offer a real-time service, so every time you refresh the page or rerun a search, you're getting the numbers and calculations at that very instant, and that's $120 per month. All right. Well, ladies and gentlemen, I don't see any other questions coming in. I want to thank you for joining me today. If you do think of a question later on, you can send me an email anytime to support@powerop.com. Remember, you can also call us during market hours. You can reach us at 302-992-7971 if you live outside the U.S., or you can reach us at 877-992-7971 toll-free if you do live inside the U.S. as well. Well, thank you, ladies and gentlemen, once again. Have a fantastic trading week, and I hope to see you soon on one of our upcoming live webinars.